Okay, so picture this. You post the single best financial year in your company's entire 106-year history.
Right.
You beat the Wall Street consensus on earnings. You beat them on revenue. You even give your shareholders a pretty significant pay raise by hiking the dividend.
Mm-hmm.
And how does the market thank you?
It punches you in the face.
Exactly. The stock sells off 4% immediately.
It is brutal. But it's also, one of the most classic, painful paradoxes in finance is the difference between looking in the rearview mirror and looking out the windshield.
It really is. Welcome back to Talk Tickers. Today, we are digging right into that paradox. We're looking at Orrstown Financial Services, ticker is ORRF, and their Q4 2025 earnings.
Yeah.
And our mission really is to solve this mystery. Why did a record-breaking year trigger a sell-off?
It's such a great case study because on the surface, everything looks rosy. But when you start to peel back the layers, you find a company that is kind of in the middle of a massive identity crisis.
An identity crisis.
Totally. They're trying to stop being a traditional bank and start being a wealth manager, all while the Federal Reserve is making their life incredibly difficult.
So it feels like a race against the clock. Can they transform the business model before the interest rate environment just eats their lunch?
That is exactly the tension. It's gravity versus lift. Gravity is the interest rates pulling them down, and the lift is this new strategy trying to, pull them up.
Okay, let's start with the rosy part first, just to set the baseline so everyone understands why that sell-off was so confusing. Q4 2025 results, what did the headlines look like?
If you were just skimming the press release or looking at a terminal, you'd be thrilled. GAAP earnings per share came in at $1.11.
And the street was expecting what, 108?
108, so a solid 3-cent beat. Revenue hit $64.92 million, which also just edged out expectations.
And if you zoom out to the full year, 2025 was a monster. Net income hit $80.9 million.
Which, to be clear, is the highest annual net income they have ever reported. In over a century of operating through the Great Depression, the Great Recession, the pandemic, they've never made this much money.
That is wild context.
Yeah.
And they're not just hoarding it, they raised the dividend again.
Right, from 27 cents to 30 cents per share. And context matters here too. That is the fourth dividend increase in the last 18 months.
Fourth, wow.
Since their merger date, the dividend is up 50%. That's a massive signal of confidence from management. They're basically shouting, we have cash, we're profitable, and we're willing to share it.
Okay, so I'm the listener. I hear record income, I hear dividend hike, and then I look at my brokerage app and see the stock down 4% at $34.57. I'm confused. I'm maybe even a little angry.
Of course.
What is the market seeing that the headline numbers are hiding?
The market is playing a different game. They aren't looking at what you did in 2025. They're betting on what you're going to do in 2026. And the sentiment right now is, show me. There is deep anxiety about how this bank handles the next 12 months.
Why?
Because the easy money has been made.
And that brings us to the first major theme of our analysis.
Yeah.
The margin squeeze. This seems to be the villain of the story.
It absolutely is. And to understand it, we had to get a little technical with a metric called net interest margin, or NEM.
Okay, define that for us. No jargon.
Sure. Think of a bank like a store. They buy money from depositors, that's you and me, by paying us interest, say 3%.
Okay.
They then sell that money to borrowers by charging them interest on loans, say 7%. The difference between those two numbers, that 4% spread, is the net interest margin. It's the raw gross profit of banking.
Okay, so for Orrstown, where is that margin sitting right now?
For Q4, it was 4.04%. Now, historically and compared to its peers, that is actually a very, very strong number. A lot of banks would kill for a 4% margin.
So what's the problem?
The problem is the trend line. It's pointing down. And management was very honest, maybe a little too honest, about the fact that it's going to keep trending down.
Why? Is it just because the Fed is cutting rates?
It's how the Fed cuts affect Orrstown specifically. See, Orrstown is what we call asset sensitive.
Break that down for me. Asset sensitive. It sounds like a technicality, but I have a feeling it impacts the wallet.
Oh, it impacts the wallet significantly. It means a huge chunk of their loans, their assets, have variable interest rates, they float.
Ah.
So the moment the Fed cuts rates, like we saw back in September and October, the interest Orrstown collects on those loans drops immediately. It's like an elevator going straight down.
But wait a minute. If the Fed cuts rates, shouldn't the interest Orrstown pays to me for my savings account also go down? Shouldn't that balance out?
Ideally, yes. But here's the catch. Deposit costs take the stairs.
The stairs.
It's called the lag.
The lag.
Exactly. Banks are terrified of losing customers. If they slash your savings rate too fast, you might take your money to a competitor or, move it to a treasury bond. So when rates fall, banks are very slow to lower what they pay you.
I see. So their income from loans drops instantly, the elevator, but their expenses on deposits stay high for months, taking the stairs.
Precisely. That gap squeezes the margin. You're getting squeezed from both sides. And there's one more technical headwind here that spooked the market. It's something called purchase accounting accretion.
That sounds like something an accountant makes up just to ruin a party. What is it?
It kind of is.
Yeah.
Think of it as phantom income from past mergers.
Phantom income.
When Orrstown bought other banks, they acquired loans that were worth less than their face value. Over time, as those loans get paid back, that difference gets booked as profit. It's basically free money that boosts your margin artificially.
So it's a sugar high.
It's a total sugar high. It makes the numbers look better than the core business actually is. And that sugar high is wearing off. Management admitted that this accretion is disappearing by 2 to 3 basis points every single quarter.
So that free boost is just evaporating.
It is, and they have to replace it with actual hard work organic growth just to stay flat.
So let me get this straight. You combine the Fed cutting rates, the deposit lag keeping costs high, and the disappearance of this phantom income, and you get what?
They get their 2026 guidance. Management said they expect in-am to fall to between 3.90% and 4.00%.
And the market saw 3.90% and just hit the sell button?
They panic sold the low end of the guidance. Investors are thinking, if rates keep falling, how low can this actually go? They don't trust the floor yet. They're imagining a world where that margin slips to 3.80% or 3.73%, and suddenly that record income evaporates.
Okay, so that is the gloom and doom. That's why the stock dropped. That explains the 4% slide. But if we stopped there, we'd be missing the most interesting part of this company. Because management isn't just sitting there letting the Fed punch them. They have a plan.
This is the second theme, and honestly, it's the reason this company is worth a deep dive. We're calling it the all-weather pivot.
Which is a fancy way of saying we need to make money in ways that don't depend on interest rates.
Correct. Fee income, the holy grail of banking. Orrstown is aggressively shifting its mix. For 3 straight quarters now, non-interest income has made up over 20% of their total revenue.
For a community bank, 20% seems high. Usually these regional banks are just taking deposits and writing mortgages.
It's very healthy. Most small banks are lucky to hit 10 or 15%, but Orrstown is pushing for more, and the engine driving all of this is wealth management.
So this is stuff like financial planning, trust services, investment advising.
Exactly that. In Q4 alone, they generated $5.7 million just from wealth revenue. This isn't a side hustle anymore. It's becoming a core pillar of the business.
And they're spending big money to grow it. I noticed they hired a new chief wealth officer, a guy named Matt Alpert.
That is a key signal. In the wealth game, you buy the jockey, not the horse. When you hire a heavy hitter like Alpert, you're usually paying a premium because you expect him to bring a massive book of business and relationships with him.
But that costs money up front.
It does, and we saw that in the expense line. But management's philosophy is invest in talent today for growth tomorrow. They are willing to eat the salary expense now because wealth revenue is sticky.
Sticky is a great word for investors. Why is it sticky?
Well, think about it. When was the last time you changed your financial advisor? It's a huge hassle.
Right.
You build a relationship. They know your kids' names. They know your retirement goals. Once you hire a wealth manager, you rarely fire them. You pay them a fee every single year, regardless of whether rates are at 5% or 0. It's high-quality, predictable revenue.
It stabilizes the ship.
Exactly. When the lending side gets rocky. And it's not just wealth management, right?
Yeah.
You mentioned merchant services.
Right, they brought that up too.
This is payment processing. Every time a business swipes a credit card, the bank takes a tiny cut. That segment grew substantially and now makes up 17% of their treasury revenue. Again, it's a bet on economic activity, not interest rates. It diversifies the risk.
So what's the target here? How big do they think this fee engine can get? Because $5.7 million is nice, but is it enough to offset that margin squeeze we just talked about?
They put a very aggressive number on it. They're targeting $13 to $14 million in non-interest income per quarter for 2026.
Whoa. If they hit that, they start to look less like a bank and more like an asset manager that just happens to have a bank attached to it.
And that is the quality compounder argument. If you can prove to the market that you can generate $50 or $60 million a year in fees, the market will eventually give you a higher valuation. You stop trading like a boring lender and start trading like a growth company.
So we have the margin squeeze pulling them down and the wealth pivot pulling them up. But what about the foundation? Are they running a tight ship, or are they spending recklessly to chase this growth?
This is theme number 3, discipline and defense.
Let's talk expenses. We mentioned they're hiring expensive talent. Did spending blow out?
It was elevated but controlled. Expenses came in at $37.4 million for the quarter, a bit higher than usual because of those hires and some healthcare costs. But their guidance is to keep it around $37 million flat per quarter going forward.
So they're trying to hold the line on costs while still hiring. That's a tough balance beam to walk.
It is. But the real defense story is in the loan book. This is the part that usually kills banks' bad loans. We've all seen the headlines about commercial real estate, right? Office towers sitting empty.
Oh, yeah. Everyone is waiting for the other shoe to drop on regional banks.
Well, for Orrstown, the shoe isn't dropping. Orrstown's credit quality is frankly boring in a very good way.
How boring are we talking?
Squeaky clean. Their provision expense, that's the money they set aside for loans they think might go bad, was only $0.1 million.
That's basically a rounding error for a bank this size.
It really is. I feel like I lose more than that in my couch cushions. And get this. Classified loans, those are the loans on the watch list that the bank is worried about, actually dropped by $5.7 million quarter over quarter.
So while everyone else is worried about a recession and office buildings defaulting, Orrstown's loan book is actually getting safer.
It appears so. And they have a massive capital cushion. Their return on average equity is almost 15%. From a fundamental standpoint, this is a fortress balance sheet. They aren't going bust. The question isn't survival, the question is growth.
Okay, so let's try to synthesize this. We have a fortress bank with record income and a rapidly growing wealth division. But the stock is down because investors are terrified of this margin squeeze in 2026.
That's the disconnect. It's what I call regional bank anxiety.
PTSD from the banking crisis a few years ago.
100%. Investors have been burned by regional banks before. They are hyper-focused on those deposit betas. How fast can you lower your costs? They just don't trust the transition story yet. They see a regional bank, they see rates falling, and they run for the exits.
It feels like the market wanted certainty. They wanted management to say, don't worry, margins will stay flat.
Exactly. But instead, management said, margins will compress a bit, but we'll make it up in fees. That introduces execution risk. Now management has to prove it.
So if I'm watching this stock, what are my catalysts for Q1? What do I need to see to believe the story?
2 things. First, show me the deposit costs are dropping. I need to see that interest expense line go down in Q1 of 2026. If rates fall and your costs stay high, the margin squeeze thesis wins and the stock probably goes lower.
And the second?
The wealth division. They put that $13 million quarterly target out there. They need to hit it. If they miss that target while margins are shrinking, the stock gets punished. But if they hit it, well, the narrative changes completely.
It really is a show me year.
It is. They are morphing from one type of company into another. And transitions are always messy. You usually look a little ugly in the middle of a makeover.
Which brings us to my favorite part of the deep dive. The part where we stop being analysts and start being, well, imaginative.
But do not try this at home segment.
Exactly. This is not financial advice. We are just 2 voices on a stream. We could be wrong. We could be crazy. Do your own diligence. But looking at this setup, the record earnings versus the skeptical market, is there a play here?
I've got one. I call this the wealth management in disguise arbitrage.
That sounds complicated. Unpack it.
It's actually pretty simple valuation math. Right now, the market is pricing Orrstown like a dusty, old-school spread lender. The George Bailey building and loan. They lend money, take deposits, they live and die by the spread.
And those companies trade at low multiples.
Super low. Maybe 8, 9, 10 times earnings, because their earnings are volatile. Low-quality earnings get a low multiple. But fee-based asset managers, wealth firms, the market loves them. They are capital light. The revenue is sticky. They scale easily. Those firms often trade at 15, 18, even 20 times earnings.
I see where you're going with this. Orrstown is acting like a wealth firm, but getting priced like a bank.
That's the arbitrage. So the trade is you go long ORRF. You collect that fat, increase dividend while you wait, and you bet on what they call multiple expansion. You're betting that eventually the market wakes up and says, hey, this isn't just a bank. This is a wealth platform.
But wait, what about the risk? What if interest rates just crush the whole sector? What if the gravity we talked about earlier pulls everything down?
That's the arbitrage part. You hedge it. You find a dumb bank to short.
A dumb bank, that seems harsh.
Okay, a traditional bank. A bank that doesn't have a wealth division. A bank that is 95% dependent on net interest margin. There are plenty of them out there. If rates plummet and margins get crushed across the industry, your short position on that bank makes money, which should offset some of the pain on Orrstown.
So you're not betting on interest rates at all. You're betting on the business model. You're betting that the wealth strategy wins.
Exactly. It's a relative value play. Long the innovator, short the dinosaur. You are isolating the specific variable of the business transformation.
I love it. It's risky, it's speculative, but it's logical.
It relies entirely on management executing that pivot. If
Yep.
they fail to grow the fee income, the whole trade falls apart.
So to wrap this up, Orrstown Financial Services, 2025 was the best year in their history. But 2026 is shaping up to be a real battleground.
It's a tug of war. On one side, you have the gravity of the Fed and falling margins. On the other side, you have the lift of this new wealth management engine.
And the winner of that tug of war determines if this stock is a value trap or a breakout star.
It's going to be a fascinating year to watch.
And for you listening, that's really the question to mull over. Do you believe in the pivot, or is that macroeconomic current just too strong to swim against?
Time will tell.
That's all for today's deep dive into Orrstown. Thanks for listening to Talk Tickers. We'll see you on the next earnings call.
See you next time.